things are shaping up in the IT sector, and HSBC has upgraded and downgraded several Indian players. What do they make of this sector? What are their top picks and what stocks should you avoid? We will cover all this and more, so make sure to stay tuned till the end of this video. First up, let's take a look at the sector as a whole. According to HSBC, the industry growth is expected to accelerate to 6% in FY26. This is from a low favorable base of 3 to 4% in FY24 and 25. Now, this is mainly due to a recovery in the US market, and the brokerage believes the IT sector will perform in line with it in 2025. HSBC also expects improving growth to attract investors to IT space versus other sectors wherein demand outlook is deteriorating but valuations are still high. On the other hand, uncertainty about generative AI, global capability center headwinds, and a weak outlook in Europe are the factors that could affect IT companies adversely. So, considering all these scenarios along with high valuations in this space, let's look at the companies that have been upgraded and downgraded. Infosys is upgraded to buy with a target price of Rs 2,120 and a 10.3% of return potential. The expectation here is for an usually weak second half for Infosys, but then 7 to 8% growth in FY26. This is thanks to a good FY25 exit rate and backlog of bookings. Also, over the past 2 years, Infosys faced multiple headwinds in terms of senior management attrition and deal losses, which in the brokerage view is now over. Second, LTIMindtree is upgraded to buy with an upside potential of 9.3% with a target price of 6,970. This is due to a favorable risk to reward as growth is accelerating while valuation is relatively attractive. Thus, expectation here again is that the worst is over and the fundamental business outlook is improving. Coming to mid-tier IT company Infosys, the upgrade to buy is at a target price of Rs 3,600 with a 17.9% of an upside potential. Infosys is now the cheapest stock in the sector and has the highest exposure to large US bank, so revival in overall tech spend and pickup in the US mortgage market should benefit the company. Now let's look at the stocks that have been downgraded. TCS is downgraded to hold at a target price of Rs 4,550, implying a 2.1% upside. TCS has recently disappointed on growth, but the brokerage expects 5 to 6% of growth to return in FY26. The biggest long-term headwind for TCS is its scale disadvantage though. Next up is Tech Mahindra. This is with a downside expectation of 15.3% on the back of its target price of Rs 1,510 and a rating revised to reduce. The brokerage believes there is little scope for upside and risks are now skewed to the downside. And lastly, coming to Coforge, the brokerage has downgraded this stock to hold with a target price of Rs 8,200, implying a 8% downside. Coforge is in the middle of integrating with Signity, but HSBC believes post a 40% run-up in 2024, any integration or business risk are not factored into the stock price. So, do you have any of these stocks in a portfolio? Are you planning to add or remove any of them? Do let me know in the comments below, and for more, stay tuned to NDTV Profit.